All right. Hello, everyone. My name is Maria Angelescu with the Mother Daughter team. And today I am joined by Tyler. He's a portfolio manager with REC Canada. So, Tyler, thank you so much for taking the time to join this call today. And basically, quick overview before we get right into it. We're going to be talking about pre-construction for beginners, pre-construction for people who have never been in the pre-construction scene, people who are thinking to buy their first pre-construction property. What is it that you need to know? What is it that you need to be aware of before you jump into that? This is all we're going to be going through today. So be sure you stick through to the very end, because there's going to be a lot of amazing information that people can really take home to make their first pre-con purchase if it's for them.
I will try my best. You gave me a great introduction, Maria. Thank you for having me.
You are going to do amazing. I have no doubt about it. You are the expert in this scene. You know what you're talking about. You've done so many pre-con deals. So just getting into the bread and butter of pre-construction. First of all, let's talk about why someone might choose to do or go down the pre-construction route versus buying, let's say, a resale property.
Yeah, sure. And pre-construction condos, the reason why an investor or a purchaser might want to, you know, go into that specific asset class, Maria, is because it is an active real estate investment, but it is by far the most passive of active real estate investments. And what I mean by that is during the construction phase, there's not much that the investor or the purchaser has to do other than pay off these incremental deposits. They're allowing the condo to build, they're allowing the area to develop and grow around the condo, and they're just paying off those incremental deposits until the condo is completed. And timelines always change depending on the type of build and the location and the builder. But for 4 to 6 years, let's call it, Maria, it is such a hands-off investment, and I think that's one of the most advantageous parts that I hear from investors. They don't want to put all their capital down at once.
Exactly. So in a way, it's kind of like a forced savings plan, right? You know that on this date, you have to have this amount of cash available. And so you're probably going to be cutting out, the Starbucks coffee every day, or, any daily habits that maybe will help you get to the point where you can pay your deposit, right? So going into the deposit structure a little bit more, knowing that the timeline that it takes to complete a project can be between, like you said, 4 to 6 years, depending on the project. How often are you finding that builders will ask to receive a deposit? So what does that schedule typically look like?
Yeah. So the typical deposit structure actually changes and it varies, and there's not one project that is the same. But I would say what to expect as someone thinking about pre-construction investing is 5% per year. So 5% in 30 days after actually doing your due diligence and securing the unit. You do 5% in 30 days, 5% at the end of the first year, 5% at the end of the second year, and then the remaining 5%, which equals 20%, Maria, is usually due on occupancy, which is about 6 months before the condo is fully completed. So, that's between that 4 to 6 year mark.
Absolutely. And do you find that there's ever an opportunity where you can negotiate the deposit structure with the builder?
Oh, for sure. There's something called incentives that you need to look at as a purchaser. And it's essentially what incentives are is what is the developer giving to you, which makes the opportunity a little bit more advantageous. And negotiating deposits is something that we do at REC Canada.
Mm-hmm.
We go into the developer's office, and one of the very first things we ask when we're trying to negotiate is how much can we stretch these the deposits, because that means that you don't have to put as much down. And interesting enough, as of August 2024, Maria, we are noticing that we have a lot more negotiation power with builders. And one of the things that they're willing to give us is less down on their condo until occupancy, for example, or really extended deposits.
So I like that you mentioned that as of this month, this year, builders are really trying to incentivize people to buy their properties. How does the pre-construction market or the interest that people have in pre-con, how is that different from what we saw over the pandemic?
Okay, so there's two answers to that question. First, in regards to negotiation powers from groups like us, REC Canada, we help in any given year between 175 to about 250 investors buy pre-construction opportunities, and we are one of the small select groups within the Greater Toronto area that can go into any developer's office and at least have a conversation with them when it comes to negotiating. Especially if we determine that it's right with the due diligence, which I'm sure we're going to be speaking about later, which determines what project is right. But at in 2020, call it between like 2017 to about 2021, Maria, we would ask for the world for our insiders in regards to incentives, extended deposit structures, lower purchase prices, cashback incentives on closing, guaranteed rent. And the majority of the time we would get laughed out of the room 9 out of 10 times. It is not the same right now. Right now, developers are leaning on groups like us and like yourself, investment-focused realtors, to bring them, their contacts to their clients, their prospective investors, to at least have conversations with. And we have had a tremendous amount of more acceptance for what we're trying to ask. In fact, they're just willing to give us at this point a lot of the things we're asking for because the market slowed. And that's the other answer to the question, which is how is the current market compared to 2020? Is complete 180. Right now, we're noticing that developers are actually not really launching any new opportunities right now.
Right.
And the reason being is that the confidence isn't there on the buying standpoint. And the construction financing with their interest rates are a lot more expensive right now with the current state of interest rates. So there are great opportunities, and our investors are being very active in that sector. But we're seeing a significant drop in regards to new inventory hitting the market for pre-construction. As well, we have to be a little bit more cautious on the due diligence because of the decade coming.
Exactly. So that being said, knowing that builders and developers, they're offering a lot more incentives these days than they were a couple of years ago. What are kind of the top incentives, let's say the top 3 incentives that you really like to see for your clients who are getting into pre-construction?
That is a great question, Maria. So there are 2 main incentives that everybody listening, if they're thinking of purchasing in Ontario, that have connected with Maria first and foremost, and are considering to purchase pre-construction in Ontario, you need 2 main incentives with every single pre-construction purchase. The first one is the ability to lease during occupancy. And Maria, what that means is when, and we'll talk about the process as well, potentially, if you want the conversation to go that way. But there's a few different stages with pre-construction. One of the stages right before closing, before you get the mortgage, is called, or when you get the mortgage, which is closing, right before that is a stage called occupancy. And occupancy, essentially, you'll be getting the keys to the condo, but you're not paying your closing costs yet. You're not getting your mortgage yet. You are paying the developer, because the condo is almost completed, but you're paying the developer a prorated rent or an occupancy fee while you're occupying the condo. And if you don't have the incentive, which is the ability to lease during occupancy, Maria, you could have the unit vacant for 4 to 6 months. I don't care what the growth looks like at that point, from now to 4 years from now. If you don't have the ability to rent it out when you get the keys to the condo and you're incurring 4 to 6 months of vacancy, it's not a good investment to me.
Right.
So you need to have that. The second incentive you need to have is the ability to assign. And what an assignment is essentially is you have the ability to sell that agreement of purchase and sale, that commitment to close on the property to another purchaser. And you're not going to be making a profit from it. In fact, in some cases, when you're actually looking at the cash required to actually go and perform this transaction, there are times, especially today with months of inventory increasing, that you're probably going to be losing a little bit of money. But the assignment is a protection for investors, because think about it. If we're buying today, that means a condo won't be, it's 2024. That means a condo won't be ready, best case, 2028, 2029. we might be in a different state at that point. We might not want to be here. We might want to be in the Caribbean at that point. We might want to go and take that money that we put into the pre-construction condo and go and invest it somewhere else because there's another opportunity that has presented itself. As you said, it is some sort of forced saving plan as well.
Mm-hmm.
The ability to assign gives the purchasers an opportunity to at least explore the option of selling it before they go and get that mortgage. So those are two mandatory incentives you need to have with every single pre-construction opportunity. Now, your question though, which is what are some other incentives that I like when I'm trying to present opportunities to our investors and to our insiders? First is extended deposit structure. We want to make sure that our purchasers put the least amount down for the longest period of time.
Absolutely.
So we're trying to extend that the deposit structure. The second incentive is the ability to get some cash back on closing, and that's one that I'm seeing developers offer a lot right now, Maria. And what that will do is that will essentially, if you negotiate it properly, will help reduce the mortgage that you're going to be getting on closing or wipe out your closing costs, depending on how much the cashback incentive is, which is great. Less money out of your pocket, which is always advantageous, especially when you're calculating your ROI because it's based off of the cash that you're putting in.
Exactly.
And then another incentive that is good to see, but we have to be careful about, is the guaranteed rents. And the reason why is we have to understand how the developer is structuring the guaranteed rent, because if we're signing a lease agreement with the developer, then the HST implications might mean that, the implications might mean that we won't get the HST rebate, or it's a lot harder to, because the CRA sees it that you're renting it out to a corporation and not an individual. But if the developer structures it properly, where the lease is the tenant that's living in the condo and you are the landlord, then that is another great incentive, because you now have the ability to have such a hands-off investment for a year and a half. No matter if it's rented or not, you're getting guaranteed rented.
Absolutely.
And that is a great one. But again, you have to speak with a legal representative, understand the HST implications, and make sure that you're able to communicate with the builder to structure it properly.
For sure. So that was an amazing answer. Thank you so much for all that information. To backpedal a little bit, because I know that you mentioned the HST rebate, what do people have to pay on the day of closing? And I know that the HST is one of the things that we see with pre-construction that we don't see with resale property. So can you touch on that a bit more?
Yeah. So here are the typical closing costs when you are purchasing a pre-construction. First are lawyer fees. I would probably budget. I used to say $1,200, but
but they've gone up.
Yeah, just like groceries, everything has increased. So budget about $2,000 for legal fees. You're going to have to pay land transfer tax. It varies depending on purchase price as well as municipality. Toronto paying the double land transfer tax.
Right.
There are developmental charges, and another incentive I didn't speak about, but we want to make sure that the developmental charges are capped, so there's no surprises for closing. And the developmental charges, they vary depending on the unit size, the area, and the building. But that is a fee that you will have to pay, and we could talk about developmental charges after, what they are. Next, there are metering fees that you're going to have to pay as well. I would probably budget, for these metering fees, educational levies, parkland improvements, maybe budget around another 10,000 or so there. It won't be that much, I don't believe, but just budget it, have it saved. And then lastly, it's HST. And HST, you're going to be charged if your plan for the condo is to be used as an investment and to rent it out. The typical cost there would be about $24,000, which seems like a big number because it is, and you need to have that saved up, Maria. But if you provide, Maria, a 1-year lease in place, if you rent out the condo to someone for 1 year, the minute you pay that $24,000, you can apply for an HST rebate. You could do it yourself. It's a very simple process, or you could work with representatives that do this for purchasers every day. And within, call it 90 to 120 days, you get about $22,000 of that back. So you get the majority of it back.
Good.
The only stipulation, though, is that you need to provide them with a 1-year lease in place, which is another reason why the ability to lease during occupancy, Maria, is so important, because you do. It's important to have that set up, because when you do pay the $24,000, we want that back as soon as possible. The minute you close on it, you pay the HST, you go and apply it. But those are the typical ones: legal fees, land transfer tax, developmental charges, metering fees, educational levies, call them, kind of additional fees, as well as HST.
So, and then touching on the HST again, because I know that you mentioned for investors, if you have that 1-year lease, you can get that money back as a rebate. What if it's your primary residence?
You wouldn't be paying the HST if you're designating it that you will be occupying it. The developer will pay it, and they will then apply for the HST rebate.
Perfect. Okay, that's good to know, just so we can clarify that bit. And this will be a great time to talk about those development charges, because we hear that and we don't really know what that term encompasses. So can you touch on that a bit more?
Yeah, so development charges, what happens when a developer wants to increase like urban density within a specific area, when they're adding, some of these condos have a few hundred units. When they're adding that many people to an area, naturally the municipality needs to improve certain things. They need to improve plumbing. They need to improve electrical infrastructure, roads, sometimes transit. Sometimes, because of the urban planning, they'll need to create new parks or new schools, depending on how much population is coming into that area. And naturally, what happens is the city will then charge the developer, saying, okay, if you want to build it, fine, but this is what you're going to have to pay for us to improve the infrastructure around the condo to support the population. And what the developer does naturally is they'll divide it by the amount of units and then divvy it out to the purchasers.
Absolutely. That makes complete sense. So have you come across instances where, let's say there isn't a clause that's included in the agreement of purchase and sale to say that there are capped development charges, and people do have to pay, an exorbitant fee, or do you find that those are typically included?
It depends on when someone has purchased it, because there's definitely times and experiences where the developer just gave them a bill of $40,000, an additional cost of $40,000 without them being aware of it, and plus more actually. And it's really important for everyone listening to make sure that every single levy, every single developmental charge is capped. Not just they group it in different, like Group A and Group B. Sometimes they'll only cap Group A and not Group B. Make sure everything's capped, all of it. So I don't care what the price is. Make sure everything's capped, because the money that you're putting in will directly determine your ROI. And if you're having to put in more money that you're not expecting, it's going to throw the investment, the calculation of your ROI, it's going to throw it in the other direction.
Exactly. And especially after paying, the deposits that you've paid, having to pay the remainder of your down payment on closing day, to be slapped with a bill that big, that hurts. That's painful. So touching on
it's
that.
It's changed now, though. It has changed.
Okay.
Yeah, it has changed. I think that's one of the things that realtors were really trying to fight for, to protect our clients, is to, whatever the number is, we got to make sure we're capping it so there's no surprises for the consumer or for the purchaser when they actually go and close on. It's important.
Absolutely. So how important is it then, or how crucial is the lawyer in the whole transaction?
Critical. The lawyer is critical. You want to make sure you work with representatives that understand the pre-construction process, and you want to connect with them as soon as you enter into your 10-day due diligence period in Ontario. You connect with them then, and you connect with them a few years later during the occupancy as well as the registration part.
Absolutely.
Critical,
so the 10-day cooling period, that's not something that we see with resale properties. So let's backpedal a little and just go over what to expect. Someone says, listen, I want to buy a pre-construction condo. What does that timeline, or what does that process look like for them?
Yeah, you can break down pre-construction into a few different stages. And the first stage is when they're going to reach out to you, Maria, to explore specific opportunities. The due diligence that we look at REC Canada when we're exploring opportunities, we wanted to check off a few of our internal, check boxes. First, we want to understand the location, and that the location is in a stage of early development and us getting in as soon as possible. We want to see transit infrastructure planning to improve, but not quite finished yet. Values always follow transit. We want to make sure that the area has a potential for diverse employment. So you have a very diverse employment structure, a very diverse tenant profile as well. Typically, when you have a few different types of businesses around you, that really hedges against market turbulence. And then the last one in regards to the area is that we want to make sure there's other developers wanting to build or securing vacant land or commercial land to build, but not yet started yet. If you can get into the area as soon as possible, as early as possible, usually those are the projects that do the best in regards to passive appreciation during the construction stage. But first, it's exploring specific opportunities. You can't pick up the building and move it anywhere else. It's so critical. Next, you want to make sure that you're working with the right builder, and Maria and her team will help everyone with that. You want a builder that has already done it in the past.
Right.
You don't want to be the test subject, even though they might build a great high-rise project. If they've never done it before, I would probably steer away from them. Let time be be that teacher there to see if they are good or not. And then lastly are those incentives that we spoke about. You want to make sure you stack as much as possible in your favor, but you need to have the ability to lease during occupancy, the ability to assign, and capped developmental charges, so you're not surprised on closing. So once you've explored a specific opportunity, you've secured the unit that you like. It could be either a bachelor, 1 bedroom, 1+10, 2 bedroom, all the way up to 3 bedrooms. I haven't seen many 4-bedroom high-rise condos, but
even the 3 bedrooms are hard to come by.
Yeah, there are, and there's some good opportunities right now actually in the assignment sector. A little sidebar there. I've been looking at that, but yeah. So once you've secured a unit, you sign your agreement of purchase and sale, you then enter in your 10-day due diligence period. That is something that protects purchasers to make sure that they're making the right decision for themselves. Because it could be a right investment for someone, but it might not be right for you. You explore that during the 10-day due diligence. I would recommend personally the first stage of securing a unit. I would recommend once everything checks off your box as a purchaser, just go and secure a unit and then do your due diligence during that 10-day process.
Right. Secure first, ask questions later.
That's right, because you could exit during that 10-day due diligence.
Exactly.
And you'll be getting your $5,000 or $10,000 deposit back. No questions asked. It's very simple.
Perfect.
And then who do you need to connect with during the 10-day due diligence, Maria? You need to connect with, first, a real estate lawyer to review the agreement of purchase and sale, as well as those potential condo documents that go and show you what the conditions and what those incentives are that were negotiated for you. You want to make sure that everything is exactly as it seems from what the developer was telling you. You should connect with a mortgage broker at that point as well to understand, is this something that could be right for you in the next few years when you do purchase it? And it's really funny, right? Because for 4 to 5 years, while the condo is being developed, Maria, nothing shows up on your credit report.
Exactly.
But you need to work with, during the 10-day due diligence period, you do need to work with a reputable investment-focused mortgage broker, because they're going to be able to tell you, is pre-construction and is that timeline right for you? And you got to make your decision there as well. During that period, you will also need a mortgage pre-approval as well. And every builder has different requirements, but that is needed, and that mortgage broker should be able to help you do that as well. Lastly, they need to connect with you and your team, Maria. They need to understand, if it's for an investment standpoint, what are projected rents at the time? What is the holding or carrying cost going to be? What can we expect in regards to development around it and potential passive appreciation growth? And you and your team can help them with that, and they should connect with you in that 10-day due diligence, because again, the purchaser needs to determine, if it is right for them or not. Now, once we've determined that this condo is right for us, we then kind of lay back a little bit in the Maria because we're going into
We
the
put our hands
construction
up.
period. Yeah, all we're doing for 4 to 6 years at this point, once we made the decision, is we're paying off those incremental deposits. We're not finding a tenant yet. We're not paying a mortgage yet. We're not paying maintenance fees. We're just making sure that we have the dates of the deposits in our calendars and making sure that there's enough funds in that account when the check is due. And that's what makes pre-construction so advantageous. Again, it's an active real estate opportunity by category, but it is the most passive of opportunities because you're not doing anything for 4 to 5 years. And during the construction period, you're really just making sure that the developer is on the right track and that the area is, doing what it needs to do in regards to growth. You want to start seeing more projects getting launched after you buy. As well, you want to make sure that there's commercial and residential development happening, around it. Now, once a condo is almost completed, at least the that interior of the unit is completed. So you have everything painted, you have your appliances in the condo, you have the bathrooms ready. You then enter in what we call an occupancy period. And usually the builder will connect with you about 3 months before that occupancy period, just to let you know. Before that occupancy period is very critical. You need to connect with 3 people. First, you need to connect with that real estate lawyer that you connected with 4 years before and let them know that my occupancy is coming up. They're going to connect with the developer's legal representative to coordinate that occupancy closing. The second person that I'd recommend connecting with is an insurance broker because you will need to secure, general content liability insurance. It's critical to connect with an insurance broker before your date of occupancy. I would say maybe about 2 weeks before, maybe. And then the third person that they need to connect with is you, Maria, especially if they're an investor, because if they're going to be renting it out, we can't do anything until they get the keys to the condo. But it's good for you you and that investor to actually go through the leasing process, the rents now because it's present, it's not in the future. What are the expected rents, and prepare the marketing assets for the rental. The minute that you get the keys to the condo and the purchaser now goes into occupancy, the minute we get that, we're putting those ads up and we're trying to find the most qualified tenant because you're competing with 50% and 60% of the building at times, depending on the condo. And we want to make sure that time is on our side. And the minute we get the keys, we go and advertise. A common question that I get from my investors is why can't we advertise it before? The reason why we can't advertise the unit before occupancy is because legally we are not allowed to. We could run an ad on the specific building to start the that intake for tenants, but it's all moot really because we can't actually go and show your condo. We don't have the keys yet either, and there are instances where the developers' lawyers have came back and sued investors because they are breaking their contract, right, which is you're leasing during occupancy, not before occupancy. So those are the 3 representatives that you would connect with before you enter into the occupancy process. Once you enter into occupancy, you're paying the developer an occupancy fee, which is essentially a prorated rent. And you're just renting it out at that point. You're trying to find that qualified tenant. If you're an investor, if you're an end user, you're just going and living in the condo essentially at that point. And you're waiting until what we call registration. Registration is when you're going to close on it. And before registration, the other person that you need to connect with is an investment-focused mortgage broker to build that financing plan. I would start that when you enter into occupancy. On closing, that's when you're going to get the mortgage. That's when you're going to be paying these closing costs, and that's when you actually secure the condo. And that's called registration or final closing, and that's usually about 4 to 6 months after you enter into occupancy.
Got you. So I'd like to talk a little more about the pre-delivery inspection, the PDI. When
Sure.
does that happen? Why does that need to happen? What do we
Yeah.
need
So
to do about it?
yes, yeah. So the PDI or pre-delivery inspection happens probably about 2 weeks before occupancy in times.
Okay.
It varies, and the PDI essentially what it is you're meeting with someone on site, someone who represents the builder, and you're going through, the actual unit itself, and you're marking all deficiencies, everything. You go through. If you see a scuff on the wall, tell him to mark that. If you see that the mirror is a little bit shifted, mark it. Every little and big thing needs to be marked because if we're looking at a building that has over 200 units, the odds are that there was something that's missed in your
Right.
condo. And the PDI, what that does is it allows the developer to fix these mistakes. And, it could take a little bit of time, but it's important to do it because you do, as an investor, have these homeowner insurances for 6 months, 1 year, 5 years, I believe. And, this protects you as a purchaser in Ontario, but you have to be able to give these inspections to the insurance company. And that's what the PDI does. A few things that I've noticed lately that purchasers should look out for, especially if there's a washer and dryer in the unit, which there will be a washer and dryer in the unit
Right.
for all new condos now, is make sure that there's grout actually on the tiles under the washer and dryer. There's a
Mm.
condo that some of our investors purchased, none of them had it. And if we didn't ask the during the PDI to have that fixed, they wouldn't have. And think of the implications there, Maria. If you have a flood, in your washer, and there's not protection, a ceiling on the tiles under it, that can go under into the other unit. And who's paying for that? That's you. You're going to be paying for that, or you're going to be going through your insurance. So these little things, you just got to make sure that they're there, and that's during the PDI. That is right before occupancy.
Perfect. Yeah, I've heard some crazy stories recently where it was a complex that had detached properties and they have forgot to put the vapor barrier
Mm,
underneath the siding. And so these are, I've talked to my home inspector before where he's getting these crazy levels of moisture in the basement because they forgot to seal something off properly, or there's
yeah,
a bunch of cracks in the foundation. And so sometimes we'll even have our own personal home inspectors go in there to go take a look and see what needs to be done or what's been missed. Because unfortunately, a lot of the time, what these builders are doing is they're trying to get these units up as quickly as possible. Sometimes corners can be cut. So, like you said, this is why we do the PDI. This is why we, try and get our own home inspectors in there as well to make sure that everything is good to go and that we aren't going to come across issues, and to ensure that we can notify the builder to say, hey, listen, these are the couple things that need to be done so that it's not done on your dime later
that's right.
down the line.
That's right. Because you have the ability to do so at that point, and you have also the right to go with the home inspector if you want. And I know a lot of our insiders do that. So that's a little bit of a pro
I
tip
would
as
totally,
well.
yeah, absolutely. I would totally do that. I recommend that to absolutely everyone.
Even a condo,
Um,
few
sorry,
hundred bucks.
yeah,
Even a condo, few $100. It's worth it. It's worth it.
it's worth every penny.
Unless you're a contractor yourself or you build homes, um, you know, I would highly in today's market recommend using a home inspector to go with you to the PDI,
Absolutely.
pre-delivery inspection.
Absolutely. So one last thing kind of before we wrap things up is we've been hearing over the last couple of years certain builders, certain developers out there who are either canceling agreements, who are asking for a way higher purchase price because we saw how the market changed, pre-pandemic to during the pandemic, and prices skyrocketed. Are there any sort of protections in place for buyers in case these sort of things happen, and when builders or developers try to pull these sort of things?
Yeah, yeah. So that's why it's always valuable, Maria, to go and speak with a real estate lawyer that specializes in pre-construction, because in those instances there was a clause there that says that the developer can raise the prices if the
Mhm.
market performs a certain way. and that wasn't caught. So in most cases, that just making sure a lawyer will review it. It might not mean that can get crossed out, but that's why you do it during the 10-day due diligence. You could just exit at that point.
And at least you're aware, right? To see if it's something that you're comfortable with or you're not comfortable with.
A way to hedge against that as well, the risk of that, is just working with reputable builders that have multiple condos on the go.
Absolutely.
It's their brand that's going to be affected, and their ability to build and to launch new. You see that more with smaller developers that are just trying to squeeze every little bit out of somebody because of market performance.
And are there, go ahead.
Yeah. No, I was going to say, like, on the other side, if the condo hasn't really appreciated in 5 years, you don't see the builder reducing prices. You agree for a price, that's the price you're going to pay for.
Exactly. So are there any telltale red flags that you look out for when you're looking at a particular builder or development?
Yeah, sure. So first and foremost, as I said before, the builder's reputation is very important. The one thing that I always want to look for is, one, have they built a high-rise condo before? If you're looking for high-rise, have they built a high-rise condo before? And do they have any currently on the go? It's important to do both, because there's a lot of builders that have in the early 2000s built high-rise, and they're trying to dip their toes in and do another project now. But the construction market has changed very drastically since the early 2000s to now. I think that's like 24 years at this point. And it's important to work with an established builder that has condos on the go. In regards to red flags, if they don't have their full developmental charges capped, that's a red flag. Potentially because the builder itself just isn't aware to cap these things. That could be a lack of experience. You also have to look at, in regards to market data, purchase price. There's a good rule of thumb, like you don't want to be really high in a purchase price per square foot compared to what the resale market is currently performing at. If it's $100, $200 price per square foot higher, that's fine, because the condo won't be ready for 6 years. You won't get a mortgage for 6 years. The market will help you there. Mm-hmm. But if we're seeing something that's like $400, $500 price per square foot above what that current market is performing, that tells you a few things. The one, that tells you potentially that you might have to put some money in on closing, because the appraisal won't come in at the price that you need it to. The other thing that tells me is the development might be really extended and delayed because of the investor pool or the purchaser pool not buying these units. Those are some red flags, I would say. Oh, and then you can also look at the condos that are already completed. Another good a good tip. Go online, research some of the condos that they've had completed, and just go into online forums just to see what people are saying about them.
Absolutely. And to finish off, have you had any personal experiences with pre-construction where there was a challenge that you had to deal with, and what was kind of the takeaway from that, or what was the learning experience from that?
Oh, there's a ton of challenges. We try at REC to make it as turbulence free, but the reality is that there will be turbulence with every single type of investment. That's not just in real estate. There's always turbulence, and you have to have a long-term hold type of mentality. Absolutely. For pre-construction. You're not day trading this. And one of the challenges that we're experiencing lately is the inability to get a mortgage right now, either with lifestyle changes or with interest rates. Now, if someone were to buy today in 2024, that should be different in 2028, 2029. We should be experiencing less or lower interest rates. But regardless, that's a challenge that I'm seeing some investors have right now. And we've found solutions for them. You either have the ability to assign, so they're exploring that option, but more or less I try to shelf that for a second and just try to go and build these creative financing plans, either connecting them with different mortgage brokers that are able to build different financing structures, like net worth assets compared to income, and as well, though, joint venture. If you try to put another investor together with that person, so sure, they give up a little bit of the equity growth, but at least they can close on it, so they're not going to be losing their deposits and potentially other legal fees. And a good a good rule is, if you're going to be buying a pre-construction condo, Maria, that you have to understand that you're not getting the mortgage for 4 to 5 years. And sure, things could come up, but you should be stable with your employment. You should not want to make any drastic changes to your lifestyle in those 4 to 5 years. If you do, or if you're expecting, for example, to retire in 3 years, maybe pre-construction isn't right. Maybe we can look at other types of opportunities where you get a mortgage today. But if you're trying to get into pre-construction and you do want to use it as an investment outlet, just try to have that long-term hold mentality, at least after closing on it, at least another 2 years. So that brings us to about, anywhere between 6 to 8 years or so.
Right. And that's that you make a very good point, is that at the end of the day, pre-construction is not for everyone, right? We hope that this video kind of explained what the options are out there and helped you narrow down whether or not Precon is for you. So that was a fantastic talk, Tyler. Thank you so much. That was a huge, huge help. I think it'll be a great educational resource, because at the end of the day, we just want to educate people to make sure that they can put the best foot forward when they're making such a huge decision, right? It is a huge investment. We're not talking about going out and buying a car even. This is a huge investment and a huge decision that people have to make. And so we're here to educate. So if there are any questions from any of the viewers that you guys have about pre-construction or want to explore it further, or just find out more if it's for you, leave any questions down below. I have my information in the bio as well, or in the caption, I guess. I'm still getting used to this whole YouTube thing. I'm like, what are the terms for YouTube? Because I'm newer to YouTube. So what
I just speak and hit post. So yeah, I'm the worst with engagement.
Yeah, right. There's a description box, whatever it is.
And Maria, thank you for having me. One thing that we didn't highlight is pre-construction's possibility.
Right.
And the possibility of pre-construction, I've seen a tremendous amount of investors really build wealth with this type of strategy. You need to find the right opportunity. You need to find it in the right location that will help you with that passive appreciation growth. And you need to understand everything that comes with that type of opportunity. But it is a great potential piece for all investors to add to their portfolio if they're trying to get this snowball effect happening, if they're trying to get this, if they're really trying to get this passive appreciation growth where they can leverage the growth and acquire new opportunities, this could be the right one. And everyone listening today, please reach out to Maria to explore these options. I know she has fantastic guides and fantastic education packages, hopefully like this, where she'll highlight the advantages and things to consider. And thank you for having me, Maria.
Thank you so much for joining. I hope you have a lovely rest of your day. And like I said, anyone who has any questions, put them down in the comment section or reach out to us directly, and have a lovely day.
Thanks.
Bye.